One of the things you bring up in your notes is just the fact that this traditional 60-40 split portfolio breakdown might not make sense right now, given what we're seeing in terms of market action. What do you mean?
Well, if you think about traditional 60-40, you've got 60% in stocks, 40% in bonds. And the expected return from bonds is lower. We're seeing market action where yields have been backing up. We all know that rates are incredibly low right now. And so really what we mean by that is you're going to need alternatives to help you deliver on some of those returns. And so particularly private equity, where we have seen stronger returns, and it also helps to diversify the portfolio.
All right. I want to also bring in Anwiti Bahuguna to this conversation, Senior Portfolio Manager and Head of Multi-Asset Strategy over at Columbia Threadneedle Investments. Anwiti, I want to get your thoughts on the market action we're seeing today, and I guess specifically where you think rates go from here and what that means for equities.
Hi, Morgan. Thanks for having me. That's an excellent question on rates. I think that's a question on everyone else's mind as well. I think for the moment, I think we may see a bit of pause given the speed with which we have seen rates rise. But looking beyond maybe a tactical range for the next few weeks or so, the move for rates, Morgan, is up. I mean, we're facing a massive upgrade to growth for the U.S. this year and potentially next year also. So I don't see rates staying low for too long.
So do you? I mean, before go ahead, Carl.
Go ahead, no, Morgan, please.
I was just going to say. So then the comments we got from David Pepper this morning, it doesn't sound like you're on board. It sounds like we're going higher.
Over the next 12 to 18 months, absolutely, rates are going higher.
Sinead, to the degree that the Fed is going to communicate whatever kind of pivot they're going to make, whether it's yield curve control, whether it's tapering, timing on a rate hike later down the road, do you think that's going to come in the form of minutes, an actual statement, an appearance by Powell somewhere? I guess we're trying to game out just how they say they're going to communicate it in time. I guess the method now is the larger question.
It's a great question, and it's really important because we've seen how some of the communications in the past perhaps have not been as smoothly received as perhaps the Fed would want them to be. But look, very clearly, short-end rates are anchored. We know that. The Fed has been very clear about communicating a more symmetrical inflation target. And so we would expect that gradually, and this is very gradually, this is not tomorrow, that you're going to see that start to be filtered into, we would expect comments at first. And let's not forget, we also get the Fed's projections every quarter. And to the extent that you're seeing a shift in expectations, that's where you'll start to see it. But we still think that the Fed has been very, very clear. The market is looking ahead to inflation. And yes, it will presumably move a little bit higher, but we do think that's transitory, and those effects will be reasonably short-lived. All of the factors that have kept inflation low since the financial crisis are still in place. So demographics, technology change, and we're really struggling to see what has fundamentally changed there.
Shepard Smith here. Thanks for watching CNBC on YouTube.